What if Japan's collapsing bond market isn't just a regional crisis, but a preview of America's financial future? In this episode of Bitcoin for Millennials, I dive deep with macro analyst Roberto Rios, aka Peruvian Bull, who's been tracking this dollar endgame for years. While most people are focused on Bitcoin's short-term price action, Roberto sees the bigger picture. It's about Japan's desperate choice between saving their currency or their bond market that reveals the impossible decisions every central bank will soon face. And here's what no one's really talking about. Roberto believes that this Japanese crisis might actually trigger the biggest Bitcoin bull run that we've ever seen. I hope you enjoyed this episode. Let's dive in. All right, Roberto Rios, welcome to Bitcoin for Millennials.
Hey, thanks for having me, Bram. It's great to be here.
Yeah, thanks so much for coming on. I really like your Substack, which is called The Dollar Endgame. And that revolves around the thesis that the global monetary system is approaching a critical inflection point due to all the unsustainable debt levels, the quantitative easing policies, and all the structural problems that basically make up the fiat currency systems. And maybe just my first question, and I think it's a very big question, but where can we kind of like start unpacking this thesis in practical terms?
Sure. I mean, obviously we could go all the way back to the invention of money and, modern paper fiat banknotes, first kind of, I would say, pioneered by the more modern Renaissance banks in Italy and Switzerland, but obviously expanded upon by the Bank of Amsterdam in 1609 or the Bank of England in the 1690s. And this fractional reserve, I guess you could say, like house of cards system, right, has perpetuated this cycle of credit ease, credit booms and credit busts, right, and then subsequent monetary responses. And so that means that the central banks are always creating essentially the same problem that they come to fight. And one of my main theses is called financial gravity and the Fed's dilemma. And that's essentially this thesis that, ironically, the problem that the central banks were aiming to solve, which was the problem of fractional reserve banking and bank runs causing the financial system to collapse, actually exacerbated its own issues and caused it to, I guess you could say, morph and proliferate and become almost like a monster, a behemoth, in terms of the financial system's size and scope and control over the modern economy. And historically, most banks were, backing their reserves by about 20 to 40% gold. So it always fluctuated, but they always had a healthy amount on hand, but it was never enough to actually redeem all the promises, right? And in Renaissance Italy, when there would be bank runs, right, there's actually drawings of this, you can look it up. And when the bankers failed to pay out all the gold, the citizens would usually beat, tar and feather, and in some cases even hang the bankers for stealing what they perceived to be their gold. I think the problem is they had a fundamental misunderstanding of the bank's business model. When you put your gold in the bank, it's no longer your gold, unfortunately. Although you may think it is, it's not your gold.
It's a claim.
It's a claim on. You get a claim on a gold. It's just a promise, and just like any promise, it can be broken. And so the central banks were designed to kind of solve this, you could say like trust problem. But all it does is kick the trust up to the central bank. Now, instead of trusting the individual bank to, pay you back your money, now you trust the central bank, and the central bank will print as much money to make all the banks solvent. But now the value of the money itself is what's in question, right? And so that's created this cycle of boom and busts, which has, I guess you could say, escalated now to this point where we're sitting at globally 130% debt to GDP, right? $300 trillion of global debt worldwide, completely unsustainable. And central banks scrambling to do QE, scrambling to do yield curve control, low interest rates to try to solve this impossible problem, which is the debt can't be paid. We cannot finance it. There's not much more room to kick the can. And at some point, we're just going to have to print the money and debase the money all the way to zero in order to make sure that all the debt is paid off.
So where does the word nominally come in? So even if your debt is paid back nominally, right, you get the amount of units back that you were promised. it doesn't mean that each of the units are worth the same, right? Because there is a time between when the debt was issued and the debt was or is paid back, and in that time, more money units have been created. And it always fascinated me that, well, when I saw that, I thought like, okay, but why are people buying certain debt, right? Like, why are they buying government bonds, for example, if they know? Because I thought, if I know, then probably the people buying the bonds will also know, right? Like, if in between more money units are created and I do nominally get paid that back, I do actually lose purchasing power on that, on all these units that I get paid back. And yeah, I always just wondered, like, why don't people see that? And yeah, I think you're a good person to ask, in the sense that, why do people perpetuate this kind of like circle jerk of money or something? Like, why don't people understand what the money should represent, basically?
I think it's because of a couple reasons. First, and I've touched on this before in podcasts, the educational system is completely beholden to Keynesian economics, right? I went and got degrees in finance and economics from a university here in the Western United States, and they taught me only Keynesian economics, only modern monetary theory, only that, government debt and government deficits are good for the economy, that government borrowing more is a good thing, that inflation is to be expected. 2% is minimum what's needed to stave off, right, a collapse of the entire system. And so people have been kind of propagandized, right, into believing this to be the case. And it's very hard to break that propaganda loop, especially once it's, rooted deeply enough. And the other thing is that I would say is, the problem is with this people buying the bonds is not that they maybe don't conceptually understand that they're not going to, be paid back in real terms. It's that the whole system is incentivized for them not to care about that. And for example, like, the banks post 2008 were there were new regulations added to bank capital ratios, including what was called Basel III, right? And the Basel III, and also some of the other banking regulations changed or created what is called the LCR and the SLR ratios, which forced banks to buy more treasury bonds. And so in order to remain a bank and to keep making money, you were regulated into buying more treasuries. And the SEC also followed up this regulation that passed in 2010 with some new regulation in 2014 that made the money market funds buy government securities, mainly treasury bills, as around 99% of their total holdings. And again, their logic, the SEC's logic, was the treasury market is more liquid, it's more safe. All these money market funds had been speculating in corporate bonds and corporate debt in 2008, and a lot of them had gone bankrupt, including the Reserve Primary Fund, which broke in 2008. And so their logic is that, well, this is a safer market, it's a bigger market, we're going to force more people into it, right? But that just creates this feedback loop where all these other banks, all these other institutions are forced into buying treasuries, forced into trading it. And they might know that long run it won't pay off, but they don't care, because all they care about is the next quarter or the next year's profit margin. And if they're making more profit and getting their bonus, and their clients are the ones who are losing money, what do they care? It's never been truly in the banker's interest to make you money. It's in their interest to make themselves money. And so if by trading treasury bonds and making you buy them and hold them on your balance sheet makes them money, they'll do it in a heartbeat.
Bitcoin custody is evolving, and OnRamp is leading this change with multi-institution custody, eliminating single points of failure. Instead of relying on one institution, OnRamp secures your Bitcoin in a cold storage multi-sig vault backed by 3 independent custodians, where no single party can move your funds alone, providing an unprecedented level of security. Your assets are protected by a 100 million Lloyd's of London insurance policy, with all transactions fully auditable on-chain and only executed at your direction. This means complete transparency and control over your assets at all times. Beyond custody, OnRamp provides comprehensive Bitcoin services that include trading, lending, inheritance planning, and IRAs. You can view them as your private Bitcoin banking partner tailored to your wealth preservation goals. Whether you're new to Bitcoin or an experienced holder, OnRamp's approach helps you secure your generational wealth with unmatched security and peace of mind. You can sign up at onrampbitcoin.com and use code BRAM, that's BRAM, to receive $150 in Bitcoin after your first deposit. If you first want to learn more, you can also book a free consultation via their website to speak with one of their Bitcoin custody experts. Tell them you came through me, and they'll take extra good care of you. My American friends, I've got something for you. If you're into Bitcoin, you want to grow your stack in any way possible. What if you could do it effortlessly just by spending your fiat? The Gemini Bitcoin credit card is designed to help you do just that by giving you instant Bitcoin rewards on every purchase. Just use it like any other credit card and earn back up to 4% on transportation, 3% on dining, 2% on groceries, and 1% on everything else. There are no annual fees for this card and no exchange fees to receive your Bitcoin rewards. Sign up to get your limited edition Bitcoin Orange credit card and earn a $200 Bitcoin bonus when you spend $3,000 in the first 90 days. You can find more information and terms in the description below or go to gemini.com/Bram to sign up today and start stacking effortlessly. That's gemini.com/Bram. Interesting, right? Like how there's like a band-aid on something that is not curable, right? Yeah. I don't know how many band-aids there are, but there are quite a few, right? Like, would you say that then like the 2008 crisis hasn't really been resolved? Like how I interpret what you just said is they force the banks to buy these government bonds to keep them capitalized, and they push them towards government bonds because that's the risk-free rate, because our country is never going to default, basically.
Yeah, essentially. I actually have a Substack piece about this called Stuffing the Coffers, if you want to go look it up, from January 2024. And in that piece, I basically lay out how the SEC and the regulators have gone through this, you could say like stealth easing program, right? A quiet injection of liquidity. And again, it's been happening for 10 years. It's been happening ever since Basel III in 2010. And not only, obviously, was there overt easing from the Federal Reserve in the form of QE and lowering interest rates. The Fed, for example, from 2008 to 2012, bought around $2.7 trillion of mortgage-backed securities. There also was what you would call covert easing, right, or stealth easing. When the Fed went out and bought this, $2.6 trillion of MBS, of mortgage-backed securities, they created new bank reserves and handed them to the banks. And then what do the banks do? Well, when you hand them new money, right, that's freshly printed, they can't go out and buy Big Macs or Beanie Babies or motorcycles or consumer goods. They go out and buy financial assets. And if you just took their mortgage-backed securities off their balance sheet, they just go buy more mortgage-backed securities. And so since 2008, the banks have bought another $2.5 trillion of mortgage-backed securities. And you can see this for yourself on Fred. If you look up commercial bank holdings of MBS, it's up and to the right. It's just been going up. So the banks themselves have also been financing, right, this speculation into mortgage-backed securities and monetization of housing. And again, the same thing is true of treasuries, right? Obviously, since 2008, the Fed has bought like $5 trillion, $6 trillion of treasuries. It's the majority item. It's the biggest item on their balance sheet. And the banks have bought around, again, $3 to $4 trillion of U.S. treasuries in that same time frame. So what this has created is what I call like a suicide pact, right? The Fed knows that it can't take all the brunt of the new treasury borrowing and all this debt issuance by itself. So it says, okay, like I'm going to go take all these banks and I'm going to pressure the regulators to pull them all into this trade with me. So now instead of just the central bank going down, now all of us go down. And by doing that, they're creating artificial demand for U.S. treasuries, right? It's fiat demand. And I mean fiat in the literal sense. Fiat means, like by force or by decree.
Let there be. Let there be.
Yes, exactly.
Yeah. Let there be demand.
Let there be demand. And so what they're doing is they're creating demand by forcing it. And again, this will work for a short period of time. It does create some, tangential demand. But the problem is after enough time, you get rid of you run out of people to pressure into buying your bonds. And at that point, then you have to print the money. And I think we're quickly reaching that point.
So in this conversation, I want to focus on what we just mentioned and how that weaves in with basically the crisis in Japan is something that you also write about extensively. You have something that you call flipping the yen, where you talk about Japan's choice between saving their currency versus their bond market. Can you explain this dilemma and also how it ties into what we just mentioned with regard to the US?
Absolutely. So Japan is critical to watch for anyone who's interested in macro or, understanding monetary economics, because Japan is essentially like what I would say the canary in the coal mine, right? They are farther down the path of QE, zero interest rates, monetary debasement than any other developed country. And it's key because they are a developed country, right? There's a structural difference between an emerging market that's still like working on building a middle class, doesn't have any high tech or high industrial sectors, and countries like Japan or the US or, France, England, the Netherlands that have advanced, technology and development, right? And so Japan, ever since the late 90s, has been experimenting with, zero and then negative interest rates, as well as quantitative easing. They're actually the people who created the term quantitative easing in March 2001 when they launched their first QE program. And then they expanded on that program in 2010 with QQE. Actually, no, sorry, that's 2013. They started their second wave of QE in 2010, and then in 2013 they started QQE, which is quantitative easing, which just means QE, but just for specific assets. So they said, hey, we're printing all this money and we're buying, it's like going to the store and buying one of every single good in the grocery store, which helps the store's profits. Okay. But they're like, well, what if the store really needs to sell their apples, or what if they really need to sell their eggs and no one's buying it? We'll go buy all their eggs. We'll go buy all their apples. And so in 2013, the Bank of Japan started their QQE program in April. And that was targeted at not only the Japanese bond market, obviously the 10-year, 20-year, and 30-year JGBs, which had low demand, right? These bonds were high yield at the time. They were trying to bring down the yields. But they also bought commercial real estate ETFs. They bought corporate equities in the Nikkei. So they started buying the Nikkei, and they've become, since 2013, they are the top shareholder of 70% of the companies in the Nikkei. 70%. So
where in the US it is treasuries, they already moved beyond.
They've already moved beyond equities.
Yes. In an attempt to just save that, in a sense, to like stabilize that, because or else it kind of shows that there is a serious problem. Is that how I can translate? That's
yes.
Right. So they're just keeping it up, basically.
Exactly.
Okay.
And again, I think the end goal of central banking is they will monetize everything, right? They will print money to buy everything. They'll print money to buy stocks. They'll print money to buy bonds. They'll print money to buy options. They'll print money to buy gold. They'll print money to buy food. They'll print money to buy, tanks. Everything will be monetized eventually. But this is the fiat disease, right? It's progressive. It doesn't start with everything. It starts with just government bonds, and then it moves to, let's say corporate bonds, and then it moves to equities, and then it moves to microcap equities, and then it moves to derivatives, and it will domino effect all the way down to the real economy eventually, which is when you see a very high inflation event, and that's when Bitcoin will really come in handy. But yeah, so Japan, then experimented with these negative interest rates from 1999. They went to zero, and then they started doing negative rates in March 2016. And launched yield curve control in September of that year. And yield curve control just means essentially QE infinity. They will print as much money as needed to bring the interest rates down to zero. And so what this created is what you would call a carry trade, right? Traders could go and borrow yen at 0% or even negative rates. And then they could go and lend in US dollars or lend in euros or lend in pounds at 2%. And so it basically generated free money, because you can borrow for nothing and you lend at something. And as long as you just hedge the currency risk, it's essentially free money. And so all these carry traders started to pile on in Japan, and Japan's all this excess liquidity that was stored up in Japan that the industrial base wasn't using and the consumers weren't using. 54% of household assets in Japan are held in cash. So all this cash, trillions, literally $10 trillion, was started to flow out into the global stock and bond markets. And again, all this carry trade started to boost up U.S. equities, U.S. bonds especially, and flow into basically every single major asset class in the world. And ever since then, the yen has started to weaken, right? And this accelerated to a great degree in 2022, because what happened in March of that year is we started the Fed's hiking cycle, which brought interest rates from the zero bound in the United States and obviously Europe up to 5 to 5.25% at the height of our hiking cycle. And I think Eurozone got to 4.5, 4.75%, pretty high too. And all this capital started flowing into U.S. stocks, U.S. bonds, because suddenly, again, people could borrow at zero in Japan and buy U.S. stocks. But the problem is this starts to hit the currency, because functionally how you do a carry trade is you borrow yen and you sell the yen to get dollars, right? So what you're doing to the exchange rate is you're taking out $1 billion loan. You sell the yen, in yen, you sell the yen on the currency market, and then you convert it into US dollars, and then you buy something in US dollars. So it weakens the currency. And all this selling pressure started to push USD JPY from 110 in 2022 to 153 as we speak today. So,
so this is basically, sorry to translate from a non-financial background, you borrow money for free in one currency. You convert it into USD, and you buy stocks with it that are also growing because of the debasement of the USD.
Exactly. But your funding cost is zero. So for other people buying US stocks, maybe you have to pay 4%, 5%. Your cost is nothing. So it's literally free money. And so that's why the yen blew out 40% in just a few years, and why inflation has also returned to Japan. But this has obviously caused the Bank of Japan to panic, because Japan is a net food and energy importer. Japan, about, I think 80% of their meat products, around 30% of their rice. They have very high tariffs on rice to protect their rice industry because they're worried about it. 90% of their energy imported. So if you let the exchange rate blow out, then the price of all your energy and your food goes up, which obviously causes very high inflation. And so they were worried. So they started doing
they need to print also.
Yes, because they need to print anyways. And they need to print because they're at 260% debt to GDP. They're far beyond the monetary event horizon, right? They're far into the black hole. And at this point, I think there's honestly no saving their central bank and their treasury, because you can't get out of 260% debt to GDP. It's impossible. 120% is already past the red line. So they're double past that. But they started doing these interventions in September of 2022, these interventions in the currency market, because they were worried about the currency blowing out. And every month they were spending between $30 to $60 billion USD in interventions. And then they started moving the interest rates higher. They started changing the bands of yield curve control starting in December 2022, but accelerating in 2023 and 2024. And then finally in August of 2024, they gave up altogether on yield curve control, and they let the bonds start to blow out. And so that piece that you referenced, Flipping the Yen, was talking about my observation that Japan had decided, okay, we've let the currency blow out hard enough. Let's now let the bonds take the pressure. But of course, the monetary policymakers didn't realize the height of their own arrogance and folly, in that the bonds blew out much more than they expected. The 30 years at 3.3% and the 40 years at 3.4%. And so at those rates, right, if you refinanced all of the government debt, they'd be paying, 10% of their GDP every year in interest expense alone. Yeah. So it's been massive.
So you mentioned they started, putting that money in the stock market, etc. And I also saw you mentioned before that Japan is basically like a testing ground for the policies of the Federal Reserve in the US. Yeah. We've seen the US government take stakes, of course, for national security, AI, energy, etc. In I think it was Intel, and there are now one or two more companies. Is this the start of something similar, or like what are you seeing that they're now also doing in the US that was also happening in Japan?
Sure. So first, obviously, the US started QE in 2008 in September, and that was precipitated by the Bank of Japan doing QE in March 2001. And although most people don't know this, the Fed actually had to kind of, you could say, like dip their toe in the water of QQE, because in March of 2020, they also bought a small amount of corporate bond ETFs. So, not directly buying equities, but getting close, because it's an ETF, right? It's the exchange traded fund of the bonds themselves. So it's getting closer to the equity and the actual bond markets. Obviously we had 0% interest rates for basically the last 15 years, right? Ever since 2008. We obviously had a small hiking cycle in 2018, 2019. Well, it ended in December 2018. Then we cut, obviously, so we paused and then we cut to zero in 2020. And then we've had a hiking cycle now, but we're obviously in the midst of cutting now, because we just had that, central bank meeting, FOMC meeting in September, where we cut 25 bips. And there's another one later this month where we're slated to probably cut another 25 bips. And there's more expectations for rate cuts in 2026. So overall, if we're going to follow the historical trend, we're probably going to go back to near zero interest rates again, and the Fed is going to have to start QE just to keep the wheels on the bus of this monetary debt machine, which is the $37 trillion treasury market.
And when you mentioned, Japan is sort of the canary in the coal mine, they are in this conundrum. Basically, it's either, okay, do I save my currency versus the bond markets? The bond markets is obviously what touches a lot of other countries, right? As the buyers. Like, how far does this still has to run? Like what is left? Are we close to a certain inflection point or not? And if we are, what kind of like spillover effects can we see happening?
Sure. So for Japan specifically, I'd say we're very near the end game, right? We're closing in. And the reason why I say that again is because of the level of debt to GDP, the strength of the carry trade, like you mentioned. This Friday, Trump put out a tweet basically claiming that we're going to do 100% tariffs on Chinese goods in retaliation for their restriction of exports of rare earth minerals. Right. And that announcement, right, and any tariff announcement, really, it will restrict global liquidity because it restricts the ability of capital to move. It makes it harder for capital to move between countries. And that means that anyone who's a liquidity-based trader, like a carry trader, has to sell their position. And so what that results in functionally is USD JPY falls, which means that the yen strengthens. So it fell from 153 in trading on Thursday to we're back at 152 now, but it fell all the way to 151.5. And that liquidation of a 1% move in the USD JPY and dollar yen resulted in a 3% move in SPY on Friday and a 9% move in Bitcoin, right? So Bitcoin fell to the low 100,000s. And obviously people are panicking, but I, again, have to remind people, this is just temporary trades from liquidity traders who are leveraged, right? These are people who borrowed a lot of yen, and suddenly the yen strengthens because there's going to be less liquidity and less carry trading going on. And then they have to liquidate their SPY position, liquidate their Bitcoin, liquidate treasuries, liquidate whatever other assets they have to meet their margin calls. And so it's not a sign that Bitcoin is actually weak or anything. It's just a trading dynamic. And in many ways, it's a good sign, right? Yeah. If SPY fell 3%, and Bitcoin fell 9, that means Bitcoin is much more sensitive to liquidity. So once the Fed or once the Bank of Japan really starts an overt easing program and printing billions and billions of dollars a month and plowing it into the market, Bitcoin is going to rally much harder than SPY will, and even harder than gold will.
If you want to self-custody your Bitcoin stack, I recommend the Blockstream Jade Plus. I've been using this premium Bitcoin-only hardware wallet for a few months now, and I love its design and ease of use. What makes it stand out is its open source hardware and software, and Blockstream's unique genuine check, which makes sure that your device is authentic. No backdoors or compromises. You can connect with the Jade Plus however you want: Bluetooth, USB-C, or you can go fully air-gapped with its built-in camera for cable-free QR transactions. The metal case feels solid and the color screen is easy to read, and it connects with your favorite Bitcoin apps like Blockstream Green, Sparrow, and Electrum. Get your Jade Plus today at store.blockstream.com and use code BRAM to get 10% of your entire order. Let's talk about something a lot of people don't think about before it's too late. Where are you storing your Bitcoin seed words? Are they truly secure? I found my solution with Stampseed. They now offer both 12 and 24 word titanium plates, so whether you're securing a hardware wallet or a multi-sig setup, they got you covered. Your seed phrase gets permanently stamped into pure titanium that withstands fire, survives water, and lasts for generations. Unlike shallow etching methods, Stampseed's patented tools help you to deeply stamp every letter for permanent readability, protecting your financial legacy. Their new kit includes test pieces for practice and is compatible with both the 12 and the 24 word plates. Paper seed phrases are a disaster waiting to happen. Secure your Bitcoin with Stampseed for decades to come. Go to stampseed.com and use code BRAM, that's BRAM, for 15% of your order.
Yeah, would you then say that either Bitcoin is a better tool for creating or at least parking liquidity, right? And then getting it when you need it, but also perhaps the thin supply that is basically there, right? Because when people sell Bitcoin and the price goes down that much, it also means that there wasn't that much Bitcoin available for sale. If I'm correct, right? Like, so if people dump and the price goes down, just means like there's just a huge percentage in increase of the available float, basically for people to buy Bitcoin. That's why the price goes down that much. I take away from that where the trading happens, right? Without people dumping, there's actually not that much for sale. Does that make sense?
Yeah. There's lower overall, like a move that high means there's lower overall liquidity, and obviously the leverage traders all got wiped out. I mean, this weekend we saw $19 billion of leverage wiped out in crypto, and a good portion of that was Bitcoin. I think people unfortunately took the incorrect belief that Bitcoin will never have any events that affect it ever again. And so they started to take leverage and 2x, 3x, 5x leverage on Bitcoin positions, which, as people are finding out really quickly, can go wrong very fast, right? Even though this is a maturing asset class in the sense that it's going to become less volatile as institutional adoption steps in, corporate adoption steps in, even nation state adoption, right? These bigger and bigger players keep coming into the Bitcoin space. There's still downside risk here, right? We're not at the point where it will never fall 10% in a day. That can still happen. So I always tell people, don't trade with leverage, don't trade Bitcoin, invest in it. And investment means buying it, taking it off exchange, and cold storage. So, I feel bad for the people who got liquidated, but I also don't, because I think it's kind of stupid that you would put the majority of your Bitcoin on an exchange and leverage it 3-to-1 and expect nothing wrong to happen.
Yeah, that's usually my reply to people. It's like, when the price goes down, it's either people selling it that don't understand it, or they're gambling with it, and that means they also don't really understand it. And yeah, so where we are right now, mid-October 2025, looking back at the US, how close are we there to actually start playing, the dollar end game as you describe it?
Sure. And, for more reference, the dollar end game is similar to the yen game, right? It's similar to every fiat currency end game. And the end game is the choice between saving your your bonds and your treasury and your financial system, or saving your currency. You can't save both. You have to choose. And there's a Hindenburg research report that came out a few years ago, and they found that out of 55 countries in the last 150 years that reached 120% debt to GDP, 54 of them either defaulted, hyperinflated, financial repressed, or simply like demonetized their currency. The only exception was Japan. And Japan is obviously clearly in the midst of its own currency crisis and bond market crisis as we speak. And it's a slow motion train crash. So it's going to take years, obviously. It's not a weekend event, but it's in progress. And so if the Japanese yen endgame is already in the fourth inning, it's already halfway through, and we're starting to see the final stages of it, I'd say the dollar endgame is in the second inning. So we're still a little early, but we're progressing very, very quickly. And one metric you can use to look at this is foreign ownership of U.S. treasuries. So from 2008 to 2015, U.S. national debt rose about $8.5 trillion, right? Foreign ownership rose about $6 trillion. So that means that foreigners bought 71% roughly of total net new U.S. debt issuance. So for every new, $1 of debt that the U.S. issued, foreigners bought 71 cents of that. And the biggest buyers were China and Japan. So China and Japan essentially helped bail us out of 2008. And then from 2015 to 2021, the debt again increased by about that amount, like another $7-8 trillion. This time, foreigners only bought 14% of it. So they bought like $1.1 trillion of debt. So that tells you that foreigners, especially even the Japanese, but especially the Chinese, the Russians, right, even the Europeans, are becoming less and less eager to buy our debt and to go into this trade of long the U.S. 30-year or 20-year bond with us. Yeah. That concern is spread throughout the financial system and is also apparent in the central bank buying of gold. So you look at 2022, 2023, 2024, each year saw record increases in, gold purchases, over 1,000 tons every single year. People's Bank of China has been accumulating gold at a record pace. We're talking, 380 tons a year, which is, equivalent to tens of billions of dollars. But the actual reserves estimates are much, much higher. They estimate they have the official reserves say 2.2 thousand tons, so 2,200 tons. But the covert analysts estimate that they hold around 5,000 tons of gold, which would be more than the US, which is over $1 trillion. Japan also obviously has been, trying to divest itself from U.S. treasuries and trying to see if there's a way that they can get out of this trade. The problem is Japan is much more closely linked, especially politically, with the U.S. than any other Asian country, because we have U.S. military bases there and we have very strong, trade alliance with them. But globally, you look at Russia, you look at Poland, you look at India, all these central banks are buying gold in record amounts. And in August 2025, so just a few months ago, and for the first time in 30 years, foreign ownership of gold holdings was more than foreign ownership of U.S. treasuries. So the global financial system is already starting to make this shift. And again, it starts with the bonds, especially the long bonds, the 30-year treasuries and the 20-year treasuries. But it's going to move down the maturity curve all the way to the shorter end of the debt, and then eventually to obviously the dollar. And that's where I think Bitcoin can play a role.
We see Bitcoin emerging, and you've talked about Bitcoin emerging as this neutral reserve asset, just like central banks, with their old paradigm hat or glasses are looking at gold, they're buying gold. That's the neutral thing. Now we have Bitcoin emerging, basically born out of all this chaos that was 2008 and the not fixing of everything that happened there, right? How obviously, I think it's clear how we look at this, but how could people look at this? Why should Bitcoin be at the same level as gold, and why how do you see it emerging as this neutral reserve asset, basically?
Absolutely. I think so. Again, I would even say Bitcoin is superior to gold. Obviously, it represents a digital form of the gold abstracted into a cyberspace, right? And that's much more useful because the fundamental problem with gold, and this is why fiat was created, this is why central banks were created, like we said at the outset, right? Like central banks, it's all an endemic problem of one of the flaws of gold, right? Gold has a lot of strong points. It doesn't rust. It doesn't oxidize, right? It's a soft metal. You can cut it easily. It's actually pretty meltable. You can purify it. You can refine it. You can use it in jewelry. You can use it in dental fillings. You can use it in space, like equipment, like satellites and stuff, because it's obviously very, very inert. So it doesn't react
and it's
to anything.
Scarce enough, but not too scarce.
Exactly. Right? It's scarce. And the supply only increases by 2% a year, 2 to 3%. And so that means that it's stable, especially as a form of a monetary medium. The problem is that because of its scarcity, it's not really usable as a medium for small transactions. So you think about it like, if you want to go buy coffee, or you want to go buy a burger, you want to go buy some gum at your convenience store, that would be worth a few shavings of gold, right? But who wants to walk around with a gold bar and have a knife or have some sort of tool and shave off some flakes of gold to pay the cashier for your pack of gum? Nobody wants to do that. And in monetary economics, this is a big issue because 99% of transactions happen below $2,000 and 90% below 1,000. And so it's a Pareto distribution, right? An inverse Pareto. And so because most transactions are actually what we would call microtransactions, that means that gold is basically unusable as a monetary medium, especially in the digital age. Nobody wants to walk around carrying around gold flakes, and a single gold coin is enough gold that's rare enough that it's so valuable that a single gold coin could buy you a car, right? It's worth, $4,000 today. That can buy you a cheap used vehicle in the US. That's not something you can use for groceries every week. So because of that flaw, because of its scarcity, which is obviously also a strength, but it's also a weakness, that means it had to be abstracted into paper money. And then the paper claims obviously can get, all called in, which causes a bank failure, which means you need a central bank to bail out the commercial bank. And so then we create all these like systems on top of systems to solve this fundamental problem. Bitcoin luckily doesn't have this issue. Bitcoin is actually divisible into 100 million sats, and each sat is sendable instantly via the Lightning Network, which can scale obviously non-linearly in regards to Bitcoin. We don't have to settle every single transaction on the base layer. We can just use Lightning between you and me, for a $2 transaction, $4 transaction. I don't need the security and the military grade encryption of the base layer every single second of every transaction that's tiny. I can just open a Lightning channel, do a bunch of transactions with you for a day, and then close it, and then have that finality at the end of the day, and know that I'm secure in all of my transactions. And so that's what Bitcoin represents. But again, as we move towards this global monetary endgame, right, this global dollar endgame, and other central banks start losing trust in the dollar, losing trust in U.S. treasuries, losing trust in bonds, and they start buying, they start looking to alternatives. Bitcoin obviously is better in terms of its digital aspect, but it's also more dangerous to them because it represents a future that they do not have control over. It represents a monetary system they do not have control over. It represents a place where they don't have an ability to print money and profit off of Cantillon effects. And so because of that, I think, unfortunately, central banks are going to be the laggards. They're going to be the last people to be buying Bitcoin. But that's also in our support, right? We want to have Bitcoin be for the people, by the people, retail investors, mom and pops, right? Small entrepreneurs, small business people, the doctors, the dentists, the lawyers. These are the people we want to get into Bitcoin. We don't want the central banks to get there first. But like I said, the real end stages of this game are where the nation states adopt it, and I still think we're a ways off from that. But we are moving towards corporate adoption, which is good.
The big question everyone obviously always has is, where is the price going? I'm not going to ask that directly, but with all of this happening, and for example, seeing a meta planet emerging in Japan as a corporate that has a Bitcoin strategy, which essentially is the only way for people to get some sort of exposure to Bitcoin in Japan. Or I think there's like one or maybe even two more companies now in Japan, but Metaplanet started this. You see movement there. We of course have had like the 3 cycles before in Bitcoin that everyone talks about, like there's 4-year cycles, etc. With everything that is happening and all these things that we're talking about, and basically the mathematically assured path that exists, do you still think there are even cycles anymore, or is this was this just like the kind of like warm up to Bitcoin being part of this dollar endgame?
That's a really good question, and I actually have talked about that. So I think as we go forward, the cycles are going to get more and more compressed, both in terms of volatility, but also time, right? I think what's going to happen is Bitcoin is going to start to hit this exponential ramp, right? Where basically, just like what's happening with gold is going to happen with Bitcoin, we're going to be seeing up every single day, and the down days are going to be by the dips, and then it's going to go up every single day for the next week or 2 weeks. And then, the bear markets and the volatile drawdowns are going to become a thing of the past eventually, right? In the shorter term, like I think this next cycle, right, if we're going to enter this, new bear market in the next year or two, I think it's going to be much less volatile, much less of a drawdown than the past. If the past was like, 70%, 80%, we're going to be maybe 50% from the highs. So I think, 60K would be like the lowest I would see us going. Probably not even that. Probably more like 70 or 80 would be lower. And then rocketing back up into the hundreds and obviously 200K. But it's similar to that. Have you seen that chart of gold in Weimar, Germany?
Yeah, it goes like
it goes volatile, but you see it's on a logarithmic scale, and it kind of like it oscillates around this exponential curve, and then finally it just goes vertical. That's what I expect to happen with Bitcoin. Infinite, basically. Exactly. Yeah. I expect it's going to be volatile, up and down, up and down, up and down, and then the volatility starts to dampen, and then it finally the market really gets it and just enters this parabolic curve, and just every day is up. Yeah. And that'll be the final is the end game.
Yeah. And I think the very important thing here to tie that together, and I want to check it with you, I think in that time with Weimar Germany, there were many options still to, let's say, move your wealth or adopt another currency, right? Like the world was less connected in a sense, right? So although that hyperinflated, there was I don't want to say quick solution, but eventually there was a solution. Of course, there was also a world war, right? But when you look at that today, why I see Bitcoin emerging is the fact that when we get to that point, let's say the US dollar does experience this Weimar Germany inflation, goes, infinite to the downside, basically, right, in value. What is the alternative in terms of another country taking over the world reserve currency, right? Because like we talked about, all the countries are based on the same flawed system. They are all intricately linked to the US dollar as the global reserve currency, right? Like that was the whole advantage that the US created after the Second World War, right? Like just the whole Bretton Woods thing. So now there isn't really an alternative other than a global decentralized neutral money that is Bitcoin. Is that how you view it too? I know it'll take some time before people understand it, but just base layer conceptually, it's like, who else can you trust? Because the mechanics and the fundamentals are all the same. So there is eventually a need for something that is trustless, basically. Mm-hmm.
Yeah, exactly. And if you ever have read my book or read any of my, especially my earlier Twitter threads on global monetary mechanics, that's exactly where I see this playing out. The US rose as the global reserve currency in the aftermath of World War II for a couple reasons. One, we had 50% of the above ground gold reserves in the world that were shipped to us from, European countries that were fighting. Two, the European countries, which were the global hegemons at the time, right? They were the colonial powers. They had all the industrial manufacturing, all the military might. They had been devastated by the war, obviously. And their devastation and the US's relative not devastation, like emerging unscathed, meant that the U.S. was primed to take the role as leader of the global economy and global, military and political system. And so, that combined with the petrodollar and the euro dollar and all these other inventions that came later helped to cement U.S. global hegemony. And the U.S. benefits from this hegemony in many ways, not only in obviously the purchasing of U.S. Treasury bonds from global central banks, from global sovereign wealth funds, from foreign corporate firms, right? Like Iranian oil suppliers or, Persian or, Turkish textile manufacturers and Japanese rice farmers that export to the U.S. All of these people earn because they export, they earn in dollars, and then they reinvest those dollars back into U.S. markets. And so that helps to pump U.S. markets up. Kind of creating this like dollar milkshake effect that Brent Johnson talks about, where U.S. markets outperform the rest of the world because we benefit from this. But what's happening with the dollar milkshake is all these countries, right, are trading with each other in U.S. dollars. And U.S. dollars, like you said, are the cornerstone of the global financial system. They represent 80% of interregional trade per a BIS paper from 2014. They represent around, 59% of global Forex reserves. Around 55% of all trade invoices are USD. 9 out of the top 10 Forex pairs have USD as the base currency, right? USD Euro, USD GBP, USD JPY, USD CNH. 9 out of 10 are USD based, and the only exception is yen to euros. That's the only one that's not USD based. But that one is something like a 20th of the liquidity of any of the other pairs. So it's used in basically all foreign currency trades, all global corporate transactions, all global trade, and again, as a foreign exchange reserve for other central banks. So if you're the ECB, if you're the Bank of England, if you're the Bank of Japan, you stockpile US dollars and US treasuries as reserves in case you need to defend against your own currency. And all of this does is create systemic demand for US dollars. It creates systemic demand for US debt and US assets because all these dollars need to be invested in something. And so that means that the US dollar is artificially strong relative to other currencies. So when other currencies, if their government decides to run a massive deficit and print a bunch of money, their currency collapses 40% in a year, right? The US dollar will only fall 5% that year because we have much more institutional and ingrained demand than any other currency ever does, right? I mean, just think about it. Like the US dollar is the only currency that has demand outside their borders. The euro doesn't have demand outside the borders. The yen doesn't. The Chinese yuan doesn't, right? The Thai baht or the Malaysian ringgit, right? Or the rupee, the Indian rupee, none of these currencies have it, but the US dollar does. And again, it's a trade-off, right? Just like in everything in economics, there's no free lunch. So for the benefit of this US dollar hegemony and for the benefit of getting stock markets that rise every single day and bond markets that are supported by the world buying, you also get an exporting of the US industrial base. You have to move US industry off of the US into other countries so that those countries become net exporters and can earn dollars because the global system needs dollars to survive. And so you need to export dollars, which means you need to import goods. So you have to run trade deficits. So that's what causes the Rust Belt states, the Midwest, to all see all the huge loss of manufacturing jobs and for rates of depression, drug addiction, right, the homelessness crisis in the US to get so much worse than even other developed countries because we have this systemic issue of becoming a net consumer, a net importer of goods, running a trade deficit or a current account deficit. But in the long run, right, if any country wants to take our crown, they have to show that their currency is more trustworthy, that their ability to consume is higher, and that their military is stronger, more influential than the US. And the problem is, like I've laid out in several of my Substack pieces, There's no currency that can do that. No single country. Russia is a country with a declining birth rate, with huge alcoholism issues. They're already fighting a war, which they've lost, hundreds of billions of dollars and they can't even fully take Ukraine. So the fact that they could fight a multi-theater war is a joke. China is facing a complete demographic collapse. They have 80 million more males than females because of the one-child policy. Their birth rate is plummeting. Same with Japan. There's really no single country that can take the mantle, right? And especially because the U.S. is a net energy food and energy exporter. We create more food and energy than we actually need, so we send it abroad. So we're able to self-sustain. We could fight wars across the world at the same time. We have a huge population. There's no other single country that can take our crown. So because of that, not even BRICS, I believe, could come close to taking out the US dollar. So the next evolution in the global monetary system is not another fiat currency. It's not another currency block. It's not a basket of commodities and a little bit of gold and some silver and some oil all stored in a warehouse, and we'll issue you the new BRICS bucks based off of it. No, that's not going to be it. It's going to be, Bitcoin, right? Eventually in the long run, because Bitcoin is the only one that is transmissible across borders, across oceans instantly. It's the only one that is trustless, peer-to-peer, right? Non-custodial. I don't have to trust anybody. I can just receive it. I can audit the entire blockchain at any point. And it solves all the problems of global trade that we faced in the 1800s under the gold standard, which was delivery, right? If France runs a trade deficit with England and they owe a bunch of gold payments to England, they should send the gold over, and they refuse. Well, then that sparks a war, right? Because France is supposed to send over 10 tons of gold to the English crown, and the English crown is mad that they didn't. So then they invade to go take their gold by force.
Mm-hmm. Yeah.
If Bitcoin,
and France
you don't
has
need
more resources to pay people because they have the gold, right? Also.
Yeah, exactly. But with Bitcoin, they don't have to wait for delivery. They don't have to say, trust me, bro. They don't have to test the bars of gold. Mm-hmm. They just say, here's our address, send us the transaction now. And then boom, 30 minutes later, you get 3 block confirmations. You want to wait 2 hours. Okay. You get even more confirmations. It's secured. You know that you got your Bitcoin instantly. Right. So that represents a revolutionary sea change in global monetary economics. And that means that this instrument, this Bitcoin currency is not only what you'd call like a bypass around Triffin's dilemma, which is the fundamental problem of all reserve currencies, right? That they have to issue more currency units outside of the central node than they do inside in order to fund global trade. The U.S. has to be a net importer to send money out, to be a dollar exporter to send money out to the global system. That's
essential to the being
to every reserve
currency, right? Like you have to export that inflation basically, because you can print it infinitely, and you want to buy other stuff with that, give other people outside of your country the currency that is now debased because it's in the global economy.
Exactly. And that's what's called Triffin's dilemma. And it's something that this economist, Robert Triffin, brought in front of Congress in February 1960, right? 11 years before the gold window was closed and before Bretton Woods broke. And he knew Bretton Woods was terminal. He said in many of his papers that the system was going to collapse, except his main folly was he believed it was going to collapse from deflation. He thought we were going to stick with the gold ratio and we weren't going to print money. He said, there's no way they're going to print the money. They know that printing more money will cause the system to collapse eventually. So they'll take the short, immediate pain rather than printing money and causing inflation and taking the long pain.
Reasonable man.
And of course, that was wrong. They took the long route. And so it took them 11 years, but they defaulted. And so Bitcoin represents a sea change in this global monetary economics because Triffin's dilemma doesn't even apply. It doesn't go around it. It completely jumps over it, right? Triffin's dilemma only applies to a centrally issued currency, but Bitcoin is decentrally issued. There's no single issuer and no one controls the supply, no one person. So that means that it's the perfect global reserve currency. And the sooner people realize that, I think the sooner the global economic system realizes that, the sooner we can move into a Bitcoinized world and a world with a much fairer and more level playing field in terms of trade and economics. And I think we'll see a boom in markets like we've never seen before.
what are like the challenges that you see on the horizon for Bitcoin to become this, what you mentioned, stay this, what you mentioned? So yeah, what are the biggest challenges you see? That could be anything, like technical, regulatory, macro, whatever.
Sure. Obviously, the first thing I would say is the monetary, like we touched on earlier, the monetary authorities, although we as Bitcoiners love to bash on the Fed and we love to bash on the ECB and we love to bash on the Bank of Japan, these people aren't stupid, right? And just like you would analyze your opponent in a chess game, you need to analyze them. And they're not going to let the system die easily. They're not going to roll over. They actually have a lot to lose. They have the most to lose, arguably, right? And the people who back them, the bankers and the corporate industrialists and, the wealthy high net worth billionaires who own billions and billions of dollars of US stocks, they don't want to see the stock market collapse. They don't want to see a deflationary collapse and all their banks fail and all their money disappears. They don't want to see that. And so they're going to do things and they're going to invent things to try to prolong the state of the system, right? And so like we mentioned earlier, that obviously started with, QE and zero interest rates in the 90s and 2000s in Japan, and then obviously the US followed suit. And it also, took place with these regulatory changes to Basel III and the SLR frameworks under Dodd-Frank and all these other regulatory acts. And they're going to continue to do things to add liquidity to the system and to prolong the survival of the system without letting people know as long as they can, right? They had the reverse repo facility, which was filled up to 2.2 trillion. They had the TGA at like 1.9 trillion. They had the BTFP, right? That loaning program that they used during the Silicon Valley Bank crisis. Whenever there's a chance for them to do some sneaky like monetary mechanics easing without telling people, they're going to do it. And that will inevitably make it harder for the system to collapse, but it eventually will. And so the hurdles we see are not only obviously to get eventual regulatory adoption, but it's to eventually force the people in power. And I say force because I truly believe that these people will never be convinced, right? The central bankers, it's going to be very hard for me to see a world in which they're finally convinced to give up control of their own currency and the money printer that they, have in their basement. They're never going to want to give that up. And so it's going to have to come basically like the internet came, like an inevitable adoption wave that nobody can stop. They call the police. They're mad. Hey, man, this Bitcoin vendor down the street from the Fed they're selling their stuff in Bitcoin, arrest them. And the cops say, hey, thanks for calling us, but we've had 10,000 calls today about arresting people. We don't have enough room in jail for arresting everybody for Bitcoin. We can't. Everyone's using it. And by the way, our officers are now demanding to be paid in Bitcoin. Do you have Bitcoin? You need to pay them. They don't want to work for you, your dirty fiat anymore. And then the central bankers are going to be, shit, man, we got to get some Bitcoin, or well, more likely they're out of a job completely. We don't need them at all. And so that's the end game. But again, they're going to put up roadblocks. They're going to use regulatory agencies. They're going to use lawsuits, and they're going to print as much money as they can to stave off collapse, as long as they can to make sure that the system stays running.
So when we think about this and kind of like look at that timeline, okay, maybe it's going to take some time, but once people now know this and that this is basically a slow motion train crash until it's not, right?
Yeah, until it speeds up and it's fast
like a nuke. Yeah. What's the playbook? Like, how do you protect yourself? Is it as basic as buy Bitcoin with everything you don't want to lose, or like how do you say this? How do people prep once they know that this is coming?
Absolutely, I would say, first off, you need to divest from bonds, government bonds, corporate bonds. I don't see a value or thesis, like trade thesis on essentially almost any bond. The only exception would be maybe like junk grade corporates that are maybe going to turn around. But owning debt is a bad idea, because they're going to demonetize, they're going to print, they're going to do everything they can to devalue the currency, and so those bonds will become worthless. Equities you can have an allocation to, but I'd be careful. Again, I'd only stay in inflation protected sectors. Things like oil and gas, agriculture, gold, real estate, things that at least have some upside when the money printer turns on. And then obviously Bitcoin. and gold. And so if some people I talk to they're too scared to dip their toe all the way into Bitcoin. They can't do a 50% allocation. And I say, look, I understand, although the toxic maxis are going to say, hey, you're either 100% in or you're a wimp, right? Some people just don't have that conviction yet. So let them do 10%, let them do 20%. And then the rest can be in gold and real estate and equities that have exposure to those industries, which is much better, far, far better than buying bonds. So that would be my recommendation. Cut your expenses, try to earn as much as possible, work hard, and buy as much Bitcoin. And if you can't get Bitcoin, then gold as you can, because what's coming is a massive wave of monetary debasement across the entire West, and Bitcoin and gold only go up in that scenario.
So buy anything the government cannot create more of, basically.
Exactly.
All right. Is there anything that you think we forgot that is important to add to this conversation?
Well, the last thing I would add is something that I've actually been getting into debates with many people about. My account is a macro account. So I touch on gold, I touch on silver, I touch on Bitcoin, I touch on US treasuries, Japanese bonds, across all things. So I talk about a wide range of things, and therefore my audience is not only Bitcoiners. And so I've gotten into arguments with a lot of them about intrinsic and extrinsic value, right? What makes something valuable? And the problem is, their belief is that all value is subjective. And I tell you, no, that's not true. There is intrinsic value. There is objective value. And objective value comes from utility value. If you're on a desert island and there's a bottle of water and a painting of a dog, which one has more value to you if there's no water on the island? I think everyone would agree, well, the painting of the dog is nice, but without the water, I die. So I should that objectively has more value, because my survival is, one of the prerequisites of me, making it off the island. And so in the same way that water has utility value, or oil has utility value, or food or land, Bitcoin has utility value because it represents an incorruptible, intangible, right, peer-to-peer monetary medium that can be transacted digitally anywhere in the world and can never be created and can never be, rehypothecated or synthesized out of thin air. You can't print it. So because of that, it represents real money. And as real money, it is a central role to play in any modern economy. You cannot run a modern economy without a monetary system. I'm sorry, it's impossible. Unless you want to go back to barter and to, I give you 2 goats for your 5 chickens. Unless you want to go back to the Middle Ages, we're going to be needing a monetary system. If we need a monetary system in the digital age, we need Bitcoin. So obviously it has utility value. Obviously it has intrinsic value. Now, whether that intrinsic value to you is worth 100,000 or 2 million, that's up to you. But if you're a buyer of Bitcoin, you are instinctively putting the value of Bitcoin above the current price, obviously. And so, I think if you truly understand Bitcoin, you understand that its actual value is technically infinite. So you would buy at any price, because again, fiat has no bottom. They can debase it as much as they want.
I think that's an interesting point. Like, the value is basically infinite because any alternative is inferior.
Exactly.
Right.
Exactly.
So
even gold, even in gold terms.
That's what I wanted to point out. Like you said, gold is used in computers and jewelry, etc. Like, I would actually say that's an anti-Bitcoin or an anti-gold argument, right? Everything you just said, if you just think about gold, it's actually a flaw that you can use gold for other utilitarian uses, right? Like the only single use of Bitcoin is money. Okay, that is where. So if that is the case, the value that you could derive from it should be in the context of money, as you just described, I think, right? And so when people say like, "Oh yeah, gold is used in computers," I would say, "Yeah, but then is it perfect nature's money?" No, it's not. It's also a conductor within the computers, right? Or it's a protection within your teeth, or it's nice to have on your face. So it is not a single use case of gold, basically.
That's right. And you could theorize hypothetically that in a pure Bitcoinized world or a hyper Bitcoinized world, there would be no other instrument with any monetary premium. right? Gold would trade just based on industrial use. Silver would trade just based on the industrial use. Copper, platinum, palladium,
Imagine
even
that.
diamond.
Wow.
Yeah.
Yeah.
Theoretically. And in that world, obviously gold is worth a lot less, especially in Bitcoin terms, right? Maybe it's worth more in fiat because fiat debates so much, and gold is scarce. But in Bitcoin terms, it's collapsed. And so when you see Peter Schiff and Mike Maloney, pounding the table and cheering and, partying every day about the gold price going up, I say, hey, look at the price in Bitcoin. It's collapsed. It's down 99.9%. It hasn't competed. And this recent move in Bitcoin, or this recent move in gold, I believe is actually foreshadowing a bigger move in Bitcoin. If you look at historical price moves in gold, it always front ran liquidity waves or liquidity injections by about 12 to 18 months. And so if this is any indication from historical precedent, we're going to be seeing another wave of QE here in the next couple quarters, and that means that Bitcoin is going to move violently up. And so I think this is your time to stack. This is your time to take your Bitcoin into self-custody, and this is your time to learn and educate yourself.
I think that's a great ender. I do want to ask you my last question, and I ask everyone the same question, which is, what is a core belief you will never let go of?
I would say the core belief I will never let go of is I don't think life and economics is a zero-sum game. I think it's a positive-sum game. I think, the more you work, the more you produce, the more value you create for other people in this world, the better the society becomes overall, right? And so a large part of economics is people trying to figure out how to distribute wealth, when the real question should be, how do we create it, right? Because human beings are born into poverty. We're born into nothing. If you just took our raw physical body and transported us somewhere, we would have nothing with us. We would have no wealth. We would have no accomplishments. We would have no systems. And so we create these things via our imagination and our intuition and our hands as well. And so even though the title of my Substack in my book is Dollar Endgame, and it sounds so scary, and it is scary because I think, like I said, I'm very black-pilled on the fiat system. I'm very white-pilled on the future, and I'm very white-pilled on and optimistic on what can happen under a Bitcoin standard, on the amount of wealth that can be created because the money and the capital is no longer perverted, and the amount of inventions and new discoveries and new science that can be pushed, and new health and medical devices that can be implemented to make people better, make people's lives better, and just the overall proliferation of abundance in the economy. It's a bright future ahead of us. Even though there's a lot of darkness we have to go through, I believe there's a light at the end of the tunnel. And that light, has to do with Bitcoin. Bitcoin will play a key role in that. So don't be black-pilled. Never listen to people who are completely doomerish. The future is bright, and in your personal life, you can always make it better by working hard and, staying true to yourself and learning about, obviously, spirituality, religion, getting connection to a higher power, I think is a very important key part of this, because this whole story, your life is about more than you. There's a bigger story playing out. So always be optimistic and always work hard.
Awesome, man. That's a great message to end. Thanks so much for your time. I really appreciate it and enjoyed this conversation. Thank you.
Of course. Thank you so much for having me.
Cheers.
I hope you enjoyed this episode. If you did, you can click here to find more just like it, and click here to find all Bitcoin for Millennials podcast episodes. Also, please like this video if you want to help shine a light on the message of Bitcoin, and subscribe to my channel to stay connected. I hope to see you for a next episode. Bye.